The Indian rupee just crashed to a record low of 89.49 against the dollar, and the Reserve Bank of India just did something they've never done before. For weeks, the RBI defended the 88.80 level like a fortress. Every time the rupee approached that line, they stepped in and sold dollars to prop it up. Yesterday, they let it break, and the rupee collapsed. Here's what mainstream media isn't telling you about this currency crisis. Foreign investors have pulled $16.5 billion out of Indian equities this year. That makes India one of the worst-hit countries for foreign outflows globally. U.S. tariffs on Indian exports that hit in August have pushed India's trade deficit to a record high, with exports to the U.S. down 9% year over year. And now, the RBI has essentially surrendered. They're no longer defending specific levels. They're letting the market decide where the rupee goes. Currency strategists are now saying 89.50 is the new resistance, and a lot depends on whether India gets a favorable trade deal with the U.S. But here's the brutal reality for everyday Indians. Every import becomes more expensive. Petrol, electronics, appliances, medical equipment. Your daily expenses are about to surge even if you don't buy imported goods directly. The rupee has now fallen over 1% in a single day, the biggest drop since May. And technical analysts warn it could test 90 to the dollar within weeks. This isn't just about currency charts. This is about your purchasing power evaporating in real time. The rupee has underperformed every major Asian currency in 2025. While other economies stabilize, India's currency keeps hitting new lows. So what happens next? 3 scenarios. Scenario 1. India negotiates a trade deal with the U.S. that rolls back tariffs. Foreign money flows back in. The rupee recovers to 85 or better. That's the bull case. Scenario 2. The trade situation stays uncertain. The RBI continues allowing gradual depreciation. The rupee grinds toward 90 over the next quarter. Inflation accelerates. This is the base case most analysts expect. Scenario 3. The trade deal falls apart completely. Foreign investors panic. The RBI runs out of reserves to defend the currency. The rupee crashes through 90 and heads toward 95. Imports spike. Inflation explodes. India enters a full currency crisis. Right now, Scenario 2 is playing out. But the risk of Scenario 3 is higher than anyone wants to admit. Because here's what the RBI knows that they're not saying publicly. Defending a currency level against persistent macro forces risks importing volatility into domestic liquidity and interest rates. By letting the rupee fall gradually, they're choosing controlled pain over catastrophic collapse. But controlled pain still hurts. Rising inflation will pressure the RBI to avoid rate cuts or even tighten rates, making home loans, car loans, and personal loans more expensive. Your savings lose value. Your debt becomes harder to service. And if you're planning to study abroad or travel internationally, those dollar costs just exploded. Comment 1 if you think the rupee stabilizes at 90. Comment 2 if you think it crashes past 95. Comment 3 if you've already converted savings to dollars. Because right now, the rupee isn't just falling. The RBI is letting it fall. And that shift in strategy tells you everything about how bad they think this could get.